Hi, welcome. I'm actually recording this lecture after having uploaded lecture 1 and lecture 2 because I got a thought that if I actually put this video a little ahead of lecture 1, it'll actually be a great value addition before you step into the world of valuation of options. So that is the reason I'm actually not going to give any number to this lecture. I don't want to again, call this lecture 1 and the subsequent change the subsequent ones. So I will just not give any number to this lecture, and I will just call it Introduction to Option Valuation, and I'll just add the topic that we're going to discuss. So what we're actually going to discuss in this video is the factors that impact the price of an option. Before going ahead into the details, what I would like to first give is a general background. Let's assume that there are two cars. Both the cars have the same characteristics. They come from the same company. They have the uh, same brand. Sorry. They have all the comfort levels are the same. You have the same leg space. Everything is the same. The only difference is one is a 5-seater and the other is an 8-seater, right? I'm assuming that everything else is actually the same, right? So I mean, this assumption is called as sorry, this assumption is actually called as ceteris paribus, right? I mean, you might have heard it a lot in economics. It's called as ceteris paribus, right? So holding everything else constant, which means assuming that both the vehicles sorry, just give me a minute. So holding everything else constant, which means assuming that both vehicle A and vehicle B have the same features and characteristics, and the only difference in both vehicle A and vehicle B is the number of seats. So vehicle A has 5 seats and vehicle B has 8 seats. Okay. Now, which one will you pay a higher price for? That is the question. Obviously, the answer is you will pay a higher price for vehicle B. The reason being, vehicle B is better off. Of course, if you are a family of 4 and you don't foresee using an 8-seater car, then it becomes a personal choice, right? But assuming that you have an 8-member family, okay, you would obviously pay more for a vehicle which has 8 seats rather than a vehicle which has 5 seats, right? Because of the more value addition that vehicle B has vis-a-vis vehicle A, right? So the feature that the underlying rule that I actually wanted to drive home is, if there is if you're comparing two products, and if product B is better than product A in a certain sense, then product B is actually going to have a higher price than product A. Okay, this is a universal, at least in theory. I'm talking in theory, right? In real world, it can, there can be specified time periods wherein there can be differences in what we are actually speaking. But in theory, product B, if it is better than product A, it should command a higher price than product A. Product B should command a higher price than product A. In our example, a vehicle with 8 seats is actually better and should command a higher price than vehicle A, right? Which has only 5 seats. So please have this in your head when we are actually now going to discuss the next topic. The topic that we are actually going to discuss is factors that impact the price of an option. What are the factors which influence the price of an option? By price of an option, I mean nothing but the premium, right? The price of an option is actually the premium that a holder pays to the writer, right? Okay, now there are totally 5 factors which impact the premium on an option. There are 5 factors are: number 1, strike price; number 2, stock price; number 3 is time to maturity; number 4 is the discount rate; and 5th is the volatility. I'll repeat all the 5 factors. 3 are obviously visible on your screen. First is the strike price, also called as the exercise price. Second is the stock price. Third is the time to maturity. Fourth is the discount rate. And 5th is the volatility. All right. So let's start with each factor that influences the premium, and then we will discuss as to how it influences a call option and a put option. First, starting with strike price or exercise price. The theoretical definition of a call option is, which I personally don't really like to use very often because it's completely bookish, is a call option is nothing but a right to buy an underlying at a certain exercise price, which is called as X. Okay. So strike price is also called as exercise price, and the notation is actually E or X, because E refers to, the letter, the word exercise price starts with E. It is also called as X because if you look at the word exercise, the impact, or the weightage is more on X, right? It's not on E. So I mean, notations can be anything, right? So I personally prefer to use X, and sometimes I might use E also. Please don't bother about that. E or X mean one and the same. Okay, don't ask me why. I mean, if it's called a strike price, don't ask me why we cannot use S, because S is the notation of stock price, of the current stock price, right? So if you use S as a notation for strike price also, then it will start getting a little confusing. Um, yeah. So the call option, like we saw, the theoretical definition is the right to buy a share, underlying, I'm assuming, is a share, at exercise price, at a certain exercise price, which is fixed in the contract. Okay. Now let's just take an example with numbers. Let's say there are two call options. The first call option gives you, the first call option has a strike price of 1,000. The second call option, let's say, has a strike price of 1,100. The first call option has a strike price of 1,000. The second call option has a strike price of 1,100. Okay, so if you stick to the theoretical definition of a call option, the first call option gives you a right to buy at a particular share for 1,000 rupees. The second call option gives you a right to buy a particular share at 1,100. Which one would you prefer? Obviously, you would prefer the first call option, right? Because that is giving you a right to buy a share at only 1,000 rupees. So the cash outflow, or the cash that you need to pay to the writer when you exercise it, is only going to be 1,000 rupees. Whereas in the second case, if you actually want to buy the share, you have to pay 1,100 to get a share, right? Assuming that it gets exercised. So which one would you actually prefer? Paying 1,000 or paying 1,100? The answer is obviously you would prefer paying 1,000, which is a lower cash outflow, correct? So now coming back to the point that we initially discussed, if there are two products and one product has a better feature than the other product, the product which has a better feature, in our case it was vehicle with 8 seats, that will have a higher price. Coming to the example that we are in options, I said the first call option, which has a strike price of 1,000, is better than the second call option, which has a strike price of only 1,100. Sorry, only was not supposed to be used. So the second call option has a strike price of 1,100. So the first call option is actually better. So if the first call option is better, then the first call option should have a higher premium, a higher price today, right? So for call option, if the strike price is lower, in our case, the strike price of the first call option was 1,000, and the second price was the strike price for the second call option was 1,100. If the strike price is lower, the call is better and hence demands a higher premium, right? So the first call option, which has a lower strike price, demands a higher premium. It's going to have a higher price. And obviously vice versa, which means the second one, which has a strike price of 1,100, is going to have a lower price. Coming to put option, the theoretical definition is right to sell at a particular strike price. Again, this is a definition that I'm purely using in this video because it makes your intuitive, it brings out the intuitive feelings in you. Otherwise, I would have preferred to use other betting sort of definitions, which I've discussed in the first lecture of option valuation, right? So put option, it gives you a right to sell at a strike price called X, which is predefined. Again, let's take the same numbers, 1,000 and 1,100. Let's say there are two put options this time. Last time it was a call option. Now we're discussing about put option. The first put option is going to give you a right to sell at 1,000, while the second put option is going to give you a right to sell at 1,100. Right? So in the first put option, you deliver a share and you receive 1,000 rupees. And in the second put option, you deliver a share and receive 1,100 rupees. Which one would you prefer? A stupid question again. You would prefer the second put option with a put option which actually has a strike price of 1100, right? Now, if you would prefer the second put option which has a strike price of 1100, that put option is a better one, right? And remember again our principle, a better put option is going to have a higher price, right? A put option which is worse off is going to have a lower price. Therefore, in case of put, if the strike price is lower, the strike price lower meaning the first put option which had a strike price of 1000, the put is a bad put. I mean, it's not the right way to say it, but on a comparative basis, it's a bad put option, right? You would prefer 1100 put versus 1000 put. And hence, this bad put is going to be available at a cheap price. And obviously, it's applicable vice versa as well, right? So call option, higher the strike price, the better it is, but also you have to pay a price for that call option to be better. Lower the strike price, sorry, I'm repeating myself. I've messed it up. I was summarizing it for put option. For put option, higher the strike price, the better it is for that. But for that to be better, you actually need to pay a higher price or a higher premium, right? A call option, if it has a lower strike price, it is better for you. And but at the same time, it comes with a cost, meaning you have to pay a higher premium for it. A higher premium for a lower strike price in case of a call option, a higher premium for a higher strike price in case of a put option. Okay. Am I talking all theory or does this actually work in practicality? It does. Okay. So I am just now going to show you as to whether it works in the real world as well. So I am on the NSE site. Let's say, I'll start from the scratch. I'm on the home screen. Okay. I am intentionally taking BPCL, which has, which was the top gainer for the day, because that will help me actually make the picture a little better for you. Otherwise, you can actually do this against any stock, right? So I have taken BPCL. So I'm searching for the stock BPCL. I'm now in BPCL. If you see over here, there are segments called as equity, derivatives, and stock lending and borrowing. I am only going to deal with equity and derivatives. I'm not going to deal with anything else, right? So in equity, if you actually see, this stock price now is 414. Of course, I'm not recording this video in active market hours. It's post market close. So the stock price, if you actually see over here, is 414.45. And the stock has actually increased today, by 20.45, right? Which means yesterday the stock was trading at 300, the stock closed yesterday at 390. It increased by 20 rupees today, 394, 394. It increased by 20.45 rupees today to close at 414.45, right? Just remember these set of figures. It was 394 yesterday. The stock price went up from 394 to 414. Let's drop the decimals, 394 and 414, right? So the stock price actually went up today. Okay. Now I'm going into the derivative segment. Okay. I am for now. Yeah. Okay. I'll go into the derivative segment. Under derivative segment, I don't want to see the futures. I want to see option contracts, right? So I am going into stock options. Okay. I have three possible expiry dates. If you see, 26th of November, 31st of December, and 28th of January. This is the last Thursday of each month, right? If you actually see, it should ideally tie back to the last Thursday of each month, right? Yeah. Okay, so 26th November in all likelihood would be the last Thursday. So I click on 26th November. You can take any other expiry date also, but I'm taking 26th November. Option type, I'm taking call option first, and then I'm choosing a strike price. If you remember, the share price moved from 394 to 414. I am taking a strike price of 400. Okay, so if you see, the call option whose strike price of 400 with 26th November as its expiry date has the last price of 29.1, right? This is the last price. Okay, so this is, let's say, the closing price of this particular call option. Okay, so the rule that we actually saw is, if the strike price is lower, the call option is better, and the call option actually has a higher premium. Okay, now let's say I increase the strike price from 400 to 420. See, just remember this carefully. The price of this call option is 29. I am increasing it. I'm changing the strike price to 420. You for one particular option of BPCL, sorry, of BPCL, you have multiple strike prices also trading. You have 400, 410, 420, 420, 430, etc. Okay? So now I have taken this call option, which whose strike price was 400, and we saw that the price was 29. Now I'm changing it to 420. If you see, the price of this is only 19 rupees or 20 rupees. The 400 call option had a price of 29. The 420 call option has a price of 19. There's a difference of about nearly 10 rupees, right? And this is actually ceteris paribus. We are holding everything else constant. By everything else constant, I mean we've not changed the expiry. We're looking for the same call option and all. We're looking for the same underlying, which is BPCL. Okay. If so, basically what I'm trying to drive home is what we are learning over there as factors which influence the price of a call option or a put option will actually work in real world as well, right? So a call option whose strike price was 400, a lower strike call option has a higher premium. And the reason it has a higher premium is because if you exercise that call option, you only have to pay 400 instead of paying 420 in this case, right? So obviously the call option with a lower strike price is better and hence commands a higher premium. The premium was 29 over there, it is 19 over here. How are these 29 and 19 calculated is actually the whole series of lectures that we intend to record under the subsequent, all the lectures that you will find in this playlist. Now let's have a look at put option. Okay. Again, I'm taking the same strike prices. Put option 420 strike price, maturity I'm not changing, has a price of 23. In case of a put option, if you recollect, higher the strike price, the better it is because you receive a higher amount, right? A strike price of 420 means you are going to receive $420 and when you deliver a share, right? So this is going to be better than receiving $400, correct? So the put option that we are looking at right now on the screen is actually better off and theoretically should command a higher premium. Okay, the premium for this put option is 23.1. Okay, now I'm changing it to 400. It should be less than the premium on 400 strike put option for the same maturity should be less than 23.1. Here you go. It is 13.25, right? So what we are actually learning here works in the real world. A quick summary in 10 seconds. Call option, lower strike price will have a higher premium. Higher strike price will have a lower premium. Put option, higher strike price will have a higher premium. Lower strike price will have a lower premium. Okay. And I don't think you have to really by heart these rules. I think it's very intuitive and keep it that way, right? It's okay if you actually spend 5 seconds in the examination hall thinking as to which one will have a higher premium or a lower premium, because it will click to you immediately. Now coming to the second factor that influences the premium, which is stock price. A call option will get exercised when the stock price is greater than the strike price. A put option, we'll discuss it later when it will get exercised. So now the call options payoff, if you're able to recollect, is actually, if it has a positive payoff, it will be S minus X. S being the share price on maturity, X being the strike price, right? So S minus X is the price of a call option, is the payoff of a call option, right? Obviously, the call option is going to have a higher payoff if S is higher, right? If S is less, the call option will have a lower payoff, right? So now let's take two call options, right? Theoretically, if the first both the call options now have the same strike price, okay? Because when we are discussing the factors which impact the price of an option, we are following the rule of ceteris paribus. We are not assuming that all things are different. We are assuming that only the stock price is different and everything else is actually the same for both the first option and the second option, okay? Now let us say there are two options having the same strike price of 100, okay? Let us say The first option that we have, the underlying share price is actually 120. And the second option, whose strike price is 100 only, has a spot price, current share price of 107. Okay, the current share price in the first, for the first option is 120. The second is 107. Okay, now which one is actually better off? And remember, the stock price that I'm taking over here is not the stock price on maturity. It is the stock price today, right? Okay, so the stock price today is 120. The stock price today is 107. Which one is better? Obviously 120, the first call option, which has a current share price of 120, is better, because the first option is a little more in the money than the second option. So if the first call option is better, which one is going to have a higher price? The first one, obviously, right? Because again, remember our old rule that we actually understood through the example of a car. A better option is going to have a higher price compared to a poorer feature option. Okay, so a call option, if the share price is higher, payoff will be more, and hence the premium will be higher. Coming to put option, if the share put option, let's take the same numbers. Let's say there are two put options, one which has a current share price of 120 with a strike price of 100, second which has an underlying share price of 107 with the strike price of 100 again. Okay, if you actually look at it, both of them are actually out of the money. They're both of them are on an absolute basis, they're actually bad put options. But which one is actually a better put option compared to the two? The second put option is actually better, because it will start giving positive payoff if the stock price falls by $7. For the first put option to start giving a positive payoff, it has to fall by $20, right? So the second put option is better off than the first put option, right? The second one was where the underlying share was 107, and the first one was where the underlying share price was 120. Okay, so the second put option, which is better off, will now command a higher premium, right? So now for the put option, if the share price is higher, share price higher meaning 120, which is the first put option, payoff will be less, and hence the premium will be lower. Perfect. Now obviously I cannot now go and find out in real world two different obviously one stock is going to have the same underlying price, right? I mean, one stock cannot have two different underlying prices. So for me to compare option 1 and option 2, option 1 should belong to one particular stock, option 2 should belong to another particular stock. Only then will they have actually different underlying prices, right? If I'm using the same underlying, let's say I'm taking BPCL underlying cannot be 120 and 107 at the same time, right? It will either be 120 or 107, right? Of course, there'll be a margin of difference in NSE and BSE, but that is not what we're talking over here, right? So obviously, when I took my example for stock price, I obviously meant that we were discussing two different options. Whereas in strike price, I was discussing about same BPCL having different strike prices, because strike prices can be different. Like we saw on the screen that there can be series of strike prices, right? From 400, 410, 420, there can be series of strike prices. Whereas underlying value, if you see over here, it's also mentioned, underlying will always be can only be one price, right? You cannot have multiple underlying prices. So technically, if you actually look, this stock price, I have to compare two stocks having same characteristics, same strike price, but different underlying price. Obviously, it's not possible for me to actually find out two stocks having the same properties in terms of all the characteristics that they have. Okay, so over here, so I cannot really show it to you in the real world, but what I will try showing you is, if you remember, let me start with call option and with a strike price of 400. Now here, I won't be changing the strike price, because strike price becomes ceteris paribus, right? I never said that the strike price is different for the two options that we're actually going to see. The strike price has to be the same, okay? Because we are assuming that the strike price is ceteris paribus, right? It's constant. We are assuming that the stock price alone is changing, okay? If you remember, the stock price actually increased from 394 to 414. It increased by 20 rupees. Okay. So as per what we actually saw over here, if the share price goes up, right? If the share price goes up, the payoff for a call option will be higher and the call premium also should be higher. Okay. If you actually look at it, I'm actually trying to bring out a pen over here. Let me just try. Yeah. Okay, perfect. Yeah, so the underlying has actually increased from 394 to 414. So the spot price has actually increased, and you expect that the call premium also has to increase for the 400 strike price, because if you look at it, this call, this call option is now in the money. Earlier, yesterday, until yesterday, the spot price was 394 and the strike price was 400, which means the call was actually out of the money. But now the underlying value has increased by 20 rupees to 414, and this call option has now become in the money, right? And actually, to show this, that is the reason I actually took the top gainer. I wanted a share which actually moved significantly, and this share price actually moved significantly today, right? Now, if you look at it, the call premium has increased by 12 or 13 rupees. The current premium is 29. Yesterday, the previous close is actually 16.2. It increased by 12.9 from 16.2 to 29.1. So when the share price increases, the call option price increases. Okay. But there is actually one wrong thing over here. The thing is, the time to maturity has actually changed. Okay, the time to maturity yesterday was 1 day higher than the time to maturity that is today. So is it correct to actually compare previous close versus current close? The answer is, strictly speaking, no. But for the sake of showing it to you, I have done it, because I cannot find two stocks which have the same characteristics with different underlying spot price alone. It's impossible for me to actually find two stocks having the same characteristics, right? So that is the reason I'm actually showing that when the share price increases, the call option premium also increases. Okay. In the theoretical example that I took, um, okay, I have to erase this, is it? Yeah. So in the example that I took over here, when explaining this piece, was I took two options having the same strike price of 100, one having a spot price of 120, and the other having a spot price of 107. Okay, this 107 and 120, actually what I explained as with 107 and 120 figures is the correct way of understanding, but practically that I cannot show you that. Okay, because 107 and 120 are actually the current share price, right? They're not share prices of two different dates. Okay, so when you take the current share price, it is at that point that I'm assuming that the time to maturity is actually constant, right? I mean, because for the both the stock prices, the time to mature for the both the options, the time to maturity is going to be the same. Whereas in the example that I took in BPCL, the stock prices of 414 and 390 are not of the same day. It is 1 day before and 1 day after. And similarly, the last price and change that I took is also not of the same at the same minute. It is of different dates. Okay. So actually, this practical example that I'm showing you is not the correct example, but it's more to just give you an intuition that what we are actually studying is actually true. When the share price goes up, rather when the share price is higher, the payoff for a call option is going to be more and will demand a higher premium. Okay, the premium in our example moved by 12.9 rupees. In case of a put option, I don't really want to show, but fine, I'll just do it quickly. The put option, the share price actually went up, and when the share price of, so yesterday the put option had an underlying value, the share had an underlying value of 394. So the put option was actually in the money yesterday, whereas it now became out of the money. Okay, so now today the put option is actually worse off. Yesterday the put option was better. So yesterday the premium should have been higher, today the premium should have been lower. So yesterday the premium was 20.3, Today, the premium is 13.25. I actually hope that the numbers are visible. I have unfortunately not taken care of that, but yeah, you can try it at your own end as well. Uh, so the premium for this put option has actually come down. But of course, this is not ceteris paribus because the time to maturity has changed. If you might actually think that I'm actually a fool. The time to maturity, if it falls just by 1 day, does it actually matter? It does matter. Okay, 1 day actually matters. Okay, so it's I will show it to you that it matters, but do not think that it's just 1 day. Heavens are not falling type. Heavens are falling. Okay. Next, coming to time to maturity. I didn't actually realize that the next point that we are going to discuss was time to maturity. But fine, now that we have time to maturity to discuss, let's start with it. For both call and put option over here, if you see, we had different set of rules. For time to maturity, it's the same. Greater the time to maturity, more the premium for an option, whether it is a call option or whether it is a put option. Now, why? The reason is, if you have a higher time period, there is a higher possibility that the share price will actually break the strike price. If you're talking about a call option, the higher the maturity, there is a greater possibility for the share price to actually go farther, away from the strike price. Or if it is a put option, you want to allow the share price to go farther away from the strike price on the downside, right? So let's now assume theoretically, and over here again we are talking about the same stock. Okay, over here we were talking about two different stocks, but time to maturity, when I'm talking about time to maturity, then I'm keeping everything else constant, right? When I mean everything else is constant, it means strike price is constant, stock price is constant. When I'm assuming that stock price is constant, it means I'm talking about the same underlying, which is BPCL in our case, and the volatility is constant and so on. Okay, so let's say there is an option, a call option on an underlying share price, whose on an underlying share whose strike price is 100 and the share price is also 100, right? Let's say the strike price and the share price is 100. So this is actually an at the money option, right? So now let's say I'm giving you two possible scenarios. The first possible scenario is the option is going to expire tomorrow. The second possible scenario is the option is going to expire after 1 year. Okay. Which is a better option? Now, the better option is an option which has a time to maturity of 1 year rather than 1 day. And naturally, if you think, the reason is, if the option has a time to maturity of 1 day, the share price today, which is 100, will move by how much? Like maybe 10 rupees, 20 rupees. Let's say even if it increases by 100%, which is virtually impossible, it will go up from 100 to 200 and you will get a payoff of maximum 100. Okay, I mean, sorry, it's actually stupid of me to actually say that the share price will move from 100 to 200. Let's say the share price will move from 100 to 110. 10% increase is also very hypothetical, but fine, let's assume. Okay, you are going to actually have a payoff of only 10 rupees. Okay, whereas if you have a time to maturity of 1 year, the share price has a possibility of increasing from 100 to God knows where, right? In 1 year, you have about 250 trading days, right? And out of 365 days, 250 are working days generally, and you have 250 trading days, right? The price from can go up from 100 to probably 200, 250 also. You do not know, right? Okay, in 1 year, there is a higher possibility for it. Definitely, you can at least say that there is a there's definitely a greater possibility that the share price will be more than 110, right? In the first case, we assume that, it will increase from 100 to 110. The possibility that the share price will be greater than 110 is obviously more for a 1 year option, right? And the same goes with put option also. Okay, if you have a strike price of 100, let's say, and if the stock price is actually going to fall, maybe in 1 day it will fall by 10 percentage from 100 to 90. 1 second. Sorry. So in 1 day, the stock price can actually fall from 100 to 90. And whereas if you have actually 1 year, the possibility of it falling greater than 90 is actually more, right? I mean, provided you're buying a put option only because you're bearish on it, correct? So obviously, greater the time to maturity, the greater the possibility of movement in stock price, and therefore it demands a higher premium. If you come over here, now let's take put option. I will only give you an example of put option. If you want, you can just check an example of call option in the interest of time, right? A put option whose expiry is on 26th of November has a premium today of 13.25, right? If I make the expiry, I'm changing the time to maturity from 26th November to 31st December, the put option price should actually increase, right? Because the time to maturity is higher. I'm actually scared. I'll tell you why. It is 26.5. I've kept everything else constant, which is the strike price is the same. I'm taking the same put option, same underlying. The strike price, the premium on the call option is 26.5. Okay, the earlier one was 13.25. This one is 26, almost double. And let's see 28th of Jan as well. 28th of Jan, it is no records. And this is why I was telling you I'm a little scared. The reason is because there is no liquidity for BPCL stock in a far month maturity option. Meaning, nobody really today wants to buy and sell a put option on at a strike price of 400 whose expiry is 28th of Jan. Fortunately, there is enough liquidity, or I don't know if there's enough liquidity. The data is not enough, but at least there have been some trades, and the premium on that is 26.5. Whereas for 28th of Jan 2021, there have been no trades at all, and that is why it says no records, right? So greater the time to maturity, more is the value of an option, because the greater is the possibility for the share price to move in a particular direction, right? Now let's come to discount rate. Discount rate, I can explain it in two methods, but unfortunately I'm not in a situation to explain the second method of understanding how discount rate impacts the premium of an option. I will have to push it to a later date. That you will learn a model called as replicating portfolio, and in that I can explain it a little better, right? I'm going to teach you the one method which is also correct. It's not that this method is incorrect, okay? In a call option, again, theoretical definition, it's a right to buy at a particular strike price. Okay, so when you're buying the underlying, you have to pay exercise price, or you have to pay the strike price on maturity. Okay, so it was a cash outflow for you, right? So let's say the strike price that we were seeing in BPCL example was 400, correct? So you, in case of, I'm talking about a call option first, I have to pay 400 to receive BPCL shares. Okay, so if the discount rate is higher, right, the present value of 400 today in today's terms is going to be lower. Higher the discount rate, lower the present value, correct? Which means the present value of cash outflow today is actually less. Okay, so obviously lesser the present value of cash outflow, the better it is for me, right? Okay, the better it is for me, it means that this put option will actually have a higher premium. Okay, so there are, let's say there are two scenarios. One where the discount rate is 10%, everything else is constant. The other where the discount rate is 7%. Okay, the discount rate, the option where the discount rate is 10% is going to obviously command a higher premium, because the present value of the cash outflow will actually be lower, and which is a better option. And that's the reason this option is a better one, and you have to pay a higher premium. The second one, 7%, the present value is going to be slightly higher. Therefore, on a comparative basis, the second option is a little worse off, and you have to, meaning you have a higher present value cash outflow, and therefore you dislike this option, and this option will have a lower premium. Okay, I can't show this in reality because obviously I cannot show you what the discount rate is, and the discount rate actually cannot be, different at the same point in time, correct? The discount rate generally will be the, for one particular share, it will obviously be the same. Okay, so this is basically assuming, to find out a sensitivity analysis type when which option is going to have a higher premium. That's it. I mean, I cannot of course it holds true in real life, but I cannot show it to you because the discount rate is not visible. Okay. In case of a put option, the theoretical definition is it's a right to receive. Give me a second. Sorry. Yeah. In case of a put option, it is a right to receive the exercise price on maturity. Okay. So you deliver a share and you receive the strike price of 400, right? Now, if higher the discount rate, you are going to have a lower present value in terms of lower cash inflow in terms of present value terms, right? Okay. And you dislike it, correct? If you have a lower discounted cash inflow in present value terms, that is a poorer option, right? For poorer option, you would pay less premium. Okay. So again, if you take the same example, strike price 400 in case of BPCL, one has a discount rate of 10%, the other has a discount rate of 7%. 10%, the present value of cash inflow of 400 is actually less. The present value of cash inflow in case of 7% discount rate is higher on a comparative basis. Therefore, the second option is better and you will command a higher premium. The first option will command a lower premium. Therefore, higher the discount rate, lower is the cash inflow in PV terms, and you will have lower put premium. Can I show this in reality? I can't. I'm sorry. Okay. Now coming to the most important one, which is volatility. Okay, so let's talk again. Volatility, like how we saw as time to maturity, has the same relationship for both call and put. Okay, remember options is all a game about volatility. Okay, this is the most important factor. I cannot stress as to how important this is, but options is completely a game of volatility. Okay, let me set the rule first. Higher the volatility, higher is the call or put premium. Both have the same relationship. Okay. Higher the volatility, higher the call, and higher the put premium. Why? If the share is more volatile, it basically means that the stock price is fluctuating widely. That is the meaning of volatile, right? The stock price is moving from 100 to 110, falling to 90, going up to 120, falling to 80. Okay, that it means it's more volatile. What is called less volatile? 100 to 101, 101 to 105, 100.5, 100.5 to 100, 100 to 99, 99 to 100. The range in which it is moving is very minuscule. Okay, that is called as a low volatile stock. Okay, if the stock price is more volatile, the possibility of the stock price breaking the strike price is actually higher if you're able to feel it, right? The possibility that the option getting exercised is higher if it is a volatile stock, and hence it demands a higher premium. Okay, let's take an example. Okay, let's say we have one call option with a strike price of $50. Okay, I am telling you that there are two possible future share prices, or rather, okay, let's take the first one. I'm saying that the share price in the first scenario can either be 70 or it can be 30. The current share price is 50. It can either go from 50 to 70 or it can fall from 50 to 30. Obviously, nobody can be certain that it will be 70 or 30. It can be 50, 51, 52, 53. I'm just creating a hypothetical example. Okay, there are only two possible prices on maturity. For instance, it can go up from 50 to 70 or it can go up from 50 to 30. Okay, if you look at it, this is a high volatile stock, and the reason I'm calling it a high volatile is because it is going up by $20 or it is falling down by $20. 20 by 50 is actually 40%, right? So 40% movement in a stock price with, let's say, maturity of 1 month, although I've not given it, is actually huge. Okay, and I'm also giving a second scenario where the share price can either go up by $1 or it can fall down by $1, which is 50. Say it can go up by 51 or it can fall to 49. This is a very less volatile stock, obviously, because 1 by 50 is a minuscule amount, correct? It's a fraction. Okay, now I'm telling you that you have to choose between scenario 1 and scenario 2 for the share price. Okay, you have an option or you have a choice I don't want to use the word option, because you will get confused with options derivatives that we are learning. You have a choice to select between scenario 1 and scenario 2. Which scenario will you actually choose? If it were in your hands to decide whether the share price will go via scenario 1 or via scenario 2, which one will you choose? Just give it a thought, and just you can pause the video and give it a thought. Okay. And of course, in scenario 1, please remember that the share price again has two possibilities. It can either be 70 or 30, and in scenario 2 it can be either 51 or 49. Okay, you have the right to choose only scenario 1 or scenario 2. You cannot choose the stock price within each scenario. Okay, now just give it a pause and then think of it as to which scenario will you prefer. I'm hoping that most of you might have got it right. Okay, you would actually, if you are a call holder, you would actually prefer scenario 1, which is A. You would want the share price to either be 70 or 30. The reason being, in the first scenario, if the share price reaches 70, your payoff is actually $20. Okay, and if the share price reaches 30, your payoff is 0. Okay, so if I look at it, you as a call option holder have you have a possibility of a payoff in scenario 1, which can be either 20 or 0. Okay, and in the second scenario, you have a possibility of it either being 51 or 49, which means payoff can either be 1 or 0. Okay, the first scenario you have a payoff of 20 or 0. Second scenario you have a payoff of 1 or 0. The thing is, if you realize, whether the stock price falls by $1 or whether the stock price falls by $20, it doesn't matter to you, because the stock price, the payoff for you is going to be 0, right? So on the downside, you actually have no worry at all. You're careless on the downside, right? Because whether it falls by $1 or whether it falls by $20, the value that you're going to lose is the same. You're going to have a 0 payoff, right? But your payoff is going to be different if the stock price increases by just $1 or if it increases by $20, right? So if you actually look at it, you are indifferent as to whether the stock price is volatile or non-volatile in case of a downfall. Whereas in case of a rise in stock price, you would obviously want the stock to actually be volatile, because there is a massive gain possible, right? Okay, on the downside, you don't have a massive loss possible. Had it been futures, okay, if you have already learned the concept of futures, then you would have been worried for scenario 1, because you have a possibility of a downfall of 20. But here, in case of a call option, you're not worried about the fall of $20 on the stock price, right? Because your payoff is going to be 0, right? So if you were to choose between, sorry, just give me a minute. So if you were to choose between a scenario 1 and scenario 2, where in scenario 1, the stock price moves rapidly, and in scenario 2, the stock price does not move rapidly, you will choose scenario 1, because in scenario 1, there is a high possibility, although you do not know that the option will get exercised, you do not know that the share price will be greater than the strike price, but still there is a higher possibility, right? If the stock price fluctuates widely, there is obviously a greater possibility or probability for the call option giving you a higher payoff when you compare it to the scenario 2, where the payoff is going to be limited, right? Because you're not exposed to the downside risk. In case of futures and forwards, you are exposed to the downside risks as well, and therefore you will not, over here you're going to be indifferent for a downfall, but in future you're not going to be indifferent, meaning you are going to take consideration of the fact that you will incur a loss of 20 if the share price falls in scenario 1, and you will incur a loss of only $1 if the share price falls by $1 in scenario 2. Okay, so options is all about a game of volatility, is a game of volatility. Okay, obviously volatile basically means higher fluctuations. I have never said that volatile means only it will go upside or only it will go downside. Volatile means it can go widely upside or it can go wildly downside, right? Okay, it can go either up or down. Less volatile means Also, it can go up or down. I'm not saying less volatile means definitely the share price will go up or definitely the share price will fall. It just means that the share price is going to be in a range bound fashion, meaning, where it is 49 to 51. It's going to be in a range bound manner. Okay. Can I actually show this in real world? Again, to show this, I will have to assume that all the underlying characteristics are actually the same, right? Compared to, meaning, the strike price is the same, the stock price is the same, etc., etc. But the volatility is different. Unfortunately, I cannot find two different stocks, okay, having the same features, because one stock price is ideally will have only one volatility, correct? Okay. So ideally, so I have to find two stocks which have the same characteristics but have different volatility, which is not possible for me. Okay. But if you actually go back to different time periods, okay, where the volatility, one time period, if you actually see where the volatility was higher, and if you take another time period where the volatility was lower, I agree we are breaking through the ceteris paribus assumption, but you will see that the call option prices have been higher in that high volatile environment compared to low volatile environment. Okay, I cannot show it to you now, but if you are able to get into have the access of the data, or maybe I will try making a separate video of it, where in case of the COVID environment, especially in March, where there was extreme volatility in the markets. If you remember, Nifty and all of them had crashed by 1,000 points. It was very volatile. The option premiums were at sky high. Okay. And if you actually go back to an environment, a peaceful environment, where there's no uncertainty and all of that, volatility is going to remain low and option premiums are going to remain less. But obviously, when you compare, you cannot, the stock prices during COVID is obviously going to be different from the stock prices now. Okay, so it's going to be a wrong comparison, but just to understand, maybe you can do that exercise at your end, or I will try to do that exercise in a separate video. Okay, so this is what I wanted to cover in this. We from lecture, I'm not giving any number to this lecture. I'm just calling this as introduction, and I will have the name as factors impacting the premium of an option. You're going to get, the actual content is going to start from the next video, wherein you're going to dig into option valuation completely. Okay, just to take a quick recap. First, we saw the vehicle example. 8-seater vehicle will have a higher price compared to a 5-seater vehicle. Because 8-seater vehicle is better off than the 5-seater vehicle, it has better features. Okay, so better feature one is always going to have a better price. Okay, the 5 factors which impact the premium of an option. 1, the strike price. For call option, if the strike price is lower, the better it is, meaning the higher the premium. Put option, higher the strike price, the better it is, because it's a cash inflow. You're going to receive the strike price as cash inflow. The better it is, so obviously higher the premium. Stock price, higher the stock price, the call is more deep in the money, the payoff is higher, and therefore this call option is better and will demand a higher premium. Put option, if the stock price is higher, the put payoff falls, and therefore that demands a lower premium. Okay, time to maturity, call and put have the same features. More the time to maturity, greater the price of both call and put options. But of course, we saw that there could be less liquidity in case the maturity is a little far off. Next, discount rate. Discount rate, there are two logics. One logic I will explain at the time of replicating portfolio. The second logic is what we saw over here. In case of a call option, the strike price is a cash outflow, right? So the present value is going to be lower. The discounted cash outflow is going to be lower today if the discount rate is higher. Okay, so you will like this call option, and hence this call option is going to demand a higher premium, right? So higher the discount rate, higher the premium. In case of a put option, higher the discount rate, lower will be the premium. Reason being, higher the discount rate, the present value of cash inflow is actually going to be less. Okay, so lower the cash inflow, you don't like this put option, right? So that's why you are ready to pay a lower premium. Volatility, the most important factor in which influences the price of an option. Higher the volatility, higher the premium of an option. we saw an example. You can probably rewind and still try to understand as to, how this is actually to be understood. It's the most important, but the problem is, strike price is clearly visible on the screen, stock price is visible on the screen, time to maturity visible on the screen, right? Discount rate fairly available, volatility is actually not really visible. Okay, if I ask you what is the volatility of this stock, of course you have, in portfolio management, you have calculated the standard deviation or volatility, but that's not the real way. That's not how real world works, right? Volatility is actually not a feature which is visible to your eyes and all, right? It's so hence actually, if your portfolio actually loses value, for instance, if you buy a stock when the if you buy an option when the environment was highly volatile, okay, and you've bought an option at that level, you're going to pay a higher premium. And now let's say the volatility crashes, okay, the stock market, I'm not saying has crashed, volatility has fallen, okay. The stock market is where it is, okay. Let's say the stock market has not moved at all, but the volatility has fallen. Why has the volatility fallen? It could be for any reason. Maybe there was some uncertainty. For instance, let's say there are elections, okay, national elections, okay. Before the national elections, obviously there's a lot of uncertainty, right? Which government will come in, what are the policies that they're going to take, okay. If the current government is going to be replaced by the new government, obviously it's going to impact all businesses completely, right? So there's a lot of uncertainty. Greater uncertainty means greater volatility, right? Okay, so at that, before the election results are out, volatility is going to be sky high, okay. So the premiums are going to be very, very high, okay. Now let's say the election results have come out, the current government itself has continued, let's assume has continued, like how what happened in 2019. BJP continued to be the central government, major party at the central government. Volatility is going to crash, okay. This is the stock market going to crash? The answer is no. If you go back and look at the date on which the election results were announced, I don't think the stock, I'm not really aware also, but I don't think the stock market would have changed drastically, but volatility would have changed, okay. And the premium that you paid, let's say it's $50, if let's assume that the premium you have paid is $50 when the volatility was high, and when the volatility falls, the premium is now going to be only about $20, let's say, okay. So now if you want to sell this option and exit your position, you will be able to sell it only for $20. You bought it at 50, you're now selling it at 20. I'm not talking, this is not option maturity, okay. You're buying and selling options, okay. You've bought an option, you can square off your position before maturity, okay. In European options also, you can sell your option, okay. I'm not saying that the option is getting exercised or pay off. European option is going to be exercised or lapsed only at maturity, but it does not prevent you from exiting your position that you have, okay. So if you actually unwind your position for $20, you have a solid loss of $30. And assume you're a student, you have to go and explain to your dad as to why why you have made such a loss, okay. Because probably you're playing, by the way, don't trade in options, huh? Please, I'm not recommending you to trade in options, but hypothetically, okay, let's say you have to go and explain it to your dad, who does not understand volatility and stuff like that, okay. He's a normal guy, and you have to explain this to him. He will ask you, dude, if the stock markets, maybe he might not call you dude, the stock markets have stayed where it is. Yesterday, when the stock market was at an X position, today also the stock market was at more or less the X position. There might have been a marginal gain or loss, okay. Why the hell have you lost $30? If he explains it to you, you're going to have a pain in your ass trying to make him understand as to why you have actually lost money. Sorry for the language, but yes, I mean, it's going to be impossible. Firstly, if you try and sit down and try explaining what options are to your dad, if he's not a finance guy, you're gone for a toss, okay. Because option, he's firstly not going to understand, call option works only on upside, downside, blah 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 blah, okay. You are fortunate for it to be a part of your syllabus, but yeah, it's basically tough. I've tried it and I'm speaking out of experience, okay. Not that I'm a bad teacher, it's just that the kind of time limit that your parents give you to explain stuff to them, might get you a little difficult. If they're available for one full day, you can teach them options as well. Okay. But basically, you're going to find it very, very difficult trying to explain why you have lost money, because nothing else has changed. And you cannot tell him that, just the current government has only continued to be the new government. Therefore, there's no uncertainty and the volatility fell down and therefore I lost my money. Okay. He will be like, what the hell? So, I mean, what if the current government continues to stay with continues to be the next government as well? Why has the volatility fallen? You will die explaining it. Okay. Anyways, the reason why volatility fell is because there's no uncertainty with regard to event. Okay. Even for an RBI meet, when an RBI is announcing interest rate, before it announces interest rate policy, volatility is going to be high. The moment the RBI governor starts speaking, you will see that volatility is actually coming down. Hope this video was helpful. Do continue to watch the remaining videos that are there in the playlist, and to get a complete insight with regard to option valuation. Thank you guys. Bye.